Hi everyone, this is Russ Connie again with Club Benchmarking. We've still got some folks coming in as is typically the case, but we're going to go ahead and get started so we can try to keep things on schedule. Um, I appreciate the fact that this is such a well-attended webinar. We actually, our system has a limit of about 120 or so, and we actually had to open a second session because we had so many people. So clearly the topic struck a chord. I know there's going to be folks coming in yet as we get rolling, but we're going to get started anyway. What we're going to do today is talk a little bit about value creation in clubs. Actually, before I get into it, there is one housekeeping item. For those folks that want to ask questions, there is a chat box down in the GoToMeeting control panel. It should be appearing somewhere on your screen, and it should be pretty obvious how to enter a chat message. So we'll either, I've got Terry Finan from our team on the session as well. We'll either pick those up as they come in, depending on what the questions are, or we'll look at them at the end and answer any questions there. So, and anything we don't catch during the webinar, we'll do our best to respond after the fact. And the second thing is that we are recording this, so this will be up on our public webpage under resources and video library. So you can go back or share this with others and hopefully get more value out of it if you look at it even a second time or share it around your board or with other folks. So we are going to spend a little bit of time, about a half an hour today, talking about value creation in clubs, which is obviously a big, broad topic. It's an important topic. It's not a topic that you can really completely cover, obviously, in 30 or 40 minutes, but we get the opportunity to go around and work with and visit hundreds and hundreds of clubs, and in addition to having the data from hundreds and hundreds of clubs, so we get to sort of look at patterns and understand what different clubs are doing, and the clubs that really seem to be hitting it out of the park, and the clubs that seem to be struggling, and we're constantly looking for patterns, whether those are financial in nature or cultural in nature, and this happens to be a topic that's really sort of an intersection of both finances and culture. Ultimately, what we'll talk about is a little bit on finances and a little bit in culture, but all with the concept of, how clubs sort of assess the value that they're bringing to the market, to their members, and how to maybe, drive a little more focus on that. So, as we talk about value creation, it's sort of an amorphous, a vague topic. What does it mean? Can it in fact be measured? How do you know if you're there? If you are there, how do you stay there? Are there things you can actually proactively do to stay there? What are the clubs that are hitting it out of the park? What are they doing differently? How do they stay there? So, it's not an exact science. This is part art and part science, and we're going to try to bring those two things together. And hopefully, I guess my goal at the end of this session is that everybody in attendance can, openly and honestly ask themselves, are we a club that's focused on value creation, or are we in a different place, of which we're going to talk about during the session? I think that's the key, is asking the question, and then almost regardless of how you answer that, saying, what are the things we could do if we're not there, we're not focused on value creation, what are the things we could do to get there? And if we are, what are the things we could do to stay there? So that's really my ultimate goal, is that it just is maybe a little bit more of an enlightenment type discussion we have today. In this notion of value creation, there are some starting thoughts that I'd like to posit, and just as a place for us all to have a baseline. Our view for a while now, and I think a lot of people have agreed with this, is that a club's initiation fee really is an excellent proxy for that club's value proposition as it's presented to its membership and as it's presented to the marketplace for prospective members. Clubs that have a zero or very, very small initiation fee clearly are portraying a different value proposition or confidence in a different value proposition than the clubs that are asking for $100 or 150 or $50,000 initiation fee. So that's a starting point we believe in. We're going to talk about the notion of capital rich versus capital starved clubs. How do you measure it and why it's important? This whole notion of value creation, it's not a snapshot in time of where we are today, but it's actually forward looking. We're big believers of every club should be thinking continuously not you can't act on it continuously, but thinking continuously. What are the things that we could do to increase the value of this club to our members and to prospective members? How do we stay relevant in the changing demographics and interest of prospective members? How do we stay relevant? So it's maintaining that value for existing and forward members. Those two things, by the way, sometimes are in conflict with each other. Obviously, you always have to look to the future in terms of where you're going to, invest in things you're going to build. And finally, the final thought is, this is cultural in nature. Clubs that are focused on value creation get those memberships get very used to value creation, and they look forward to the club doing new and innovative things. Sometimes they require lots of investment, sometimes they don't, but they're of value to the membership. So that's a good thing, because it drives the ability and the confidence of the board, and it drives capital income. It drives all kinds of things when that value creation is ingrained in the culture. So, there we go. So in this as we've visited so many clubs, and I've stated that we see lots and lots of clubs that are on the high, oriented towards value creation. And the other way, if you're going to sort of bookend the spectrum, we put on the other end of the spectrum the clubs that are stuck in a cost-cutting culture. So, complete value creation on one side of the board, cost-cutting on the other side. And there's a set of attributes that now we've in fact seen that exist in this one set of clubs versus the other set of clubs. It's not easy to get from one to the other, but there are a set of attributes that every club can aspire to, assuming that every club wants to have a culture of value creation. One is generally they have a strong dues engine. What does that mean? It means generally they have a strong membership in terms of both their member account and how much it costs to be a member in terms of annual dues rate. The second is they obviously to be generating value and investing in the club, you need to have capital. So they tend to be capital rich clubs. It's sort of self-evident, and there's a chicken and the egg thing that happens here, right? Which comes first, value creation or capital rich? As you'll see in a minute, our thesis isn't that it's a starting point, but it's a continuous loop, and you have to get in that loop. But clubs, this is more tactical in nature as a pattern, but clubs that are value oriented tend to view food and beverage as an amenity. They're not trying to drive dollars out of food and beverage. They recognize that it's an amenity, like golf is an amenity, like tennis is an amenity, like fitness is an amenity. Food and beverage is an amenity as well in value oriented clubs. There's a rising expectation from the membership. What are we doing next? What's coming up next? There's a focus on the future at the board and at the management level. And there's, cost efficiency as part, obviously, that's sort of motherhood and apple pie on that side. But on the cost cutting side, what do the clubs look like that we've been in, that when you walk out the door after a session, you say, these guys are trying to cut their way to health. They're in a cost cutting culture. Tends to be a weak dues engine. The membership has maybe member counts have dwindled, or maybe they've been afraid, they haven't had the confidence to raise dues, or for whatever reason haven't raised dues, and their dues engine is weak. Capital starved. They don't have a lot for investment. Either that's because they don't have an initiation fee, because their weak dues engine is driving an operational loss and they're stealing their capital to patch up operations. But there's a myriad of reasons, but fundamentally they're capital starved. They tend to view F&B as the profit center. We know the clubs. How do we make money in F&B? How do we drive profit out of F&B? There's a yellow flag there. That's a club that may not be so oriented on value creation and may be a little bit stuck on the sort of that cost management. I won't call it cost cutting. I'll call it cost control. And the member, as a result of the top three, what do you tend to get some cultural behaviors, which are there's a diminishing expectation, right? The mindset tends to be how much can we cut and keep people just happy enough. Very focused on the present. They're not looking 2 or 3 years down the road. They're worried about how the heck we paying the bills, and how do we not how do we drive this budget that we've currently got, and it tends to be cost cutting. Hey, we have too much labor. Can we cut the superintendent's budget back? Can we move from a 42% cost of food to a 39% cost of food, right? It's cut. So I spent a little time on this chart, but That's the cultures that we see in the book end of it, and obviously you have clubs that fit across the middle of that. When you look at the big picture thesis here of clubs that, do we invest or don't we invest? And again, using those same notions of value creation clubs and maybe cost cutting clubs. And in this pie, I'm using this chart, I'm using the notions of clubs that are in the growth cycle and clubs that are in the decay cycle. For clubs that are in the decay cycle, I guess we'll start with that one in this case. And we're going to start down here at this lower right. You tend to have clubs, they don't have the capital. So they have restricted capital investment. That drives a narrowing or narrower amenities. And hey, we know it, we see it, deteriorating facilities. You can tell when you walk through the door of a decaying club, a capital-starved club. You tend to have relatively low member satisfaction, certainly low member expectations. Now, satisfaction expectations, dovetail. But generally, if you've got restricted capital investment, you tend to see a lower demand scenario. The marketplace exists for clubs too, right? It's a supply and demand marketplace. And part of investment is creating demand. So clubs that do lower investment generally have a harder time, generating demand for folks to be a member at the club. And that manifests itself ultimately in, lower initiation fees, fewer members, which means decreased capital income. We're going to talk in a minute a little bit more about the notion of return on capital in clubs, but obviously lower return, and this just feeds on itself, right? You can't get out of this loop. Very hard to get out of that loop. And on the flip side, you've got the growth cycle clubs that have momentum in this cycle, right? So they're in a cycle. Maybe I've heard a few clubs that are clearly in this cycle literally tell me we try to have a cycle of every 2 to 3 years rolling out something significant, not small, but significant, that our members are excited about when it rolls out, but maybe more importantly, excited about it as we talk about it, coming down the road in 2 or 3 years. So those are clubs that have, higher levels of capital investment, increasing capital investment, in fact, broader sets of services and amenities and facilities. What does that ultimately do? As I said, you're trying to drive demand. So that investment, and here's where investment choices become important, right? Are you making investment choices that in fact increase member satisfaction and increase interest in joining? Are they things that are visible to the membership? Some things are, some things aren't. Of course, that we're big believers that, and if you're doing a significant project that we say, yeah, this is a high value project, we always put, the next question is, and are you going to raise your initiation fees as a result? As you build things that are of value, add things that are of value, the question should always be asked, does this allow us to increase our initiation fee? If the answer is no, then you might have to go back and ask the question, is this really a member value investment, right? Because those two things should dovetail pretty closely. Obviously, higher initiation fee and more members drives increased capital income, which brings more capital into the coffers, and you stay on that cycle. So it's easier to stay on this cycle than it is to get in this cycle. If you're on the K cycle, the only way you can, we'll talk a little bit more about it later, the only way you can get into this cycle is to frankly be fairly bold, because it's not an easy decision. It's not an easy thing to say we're in a little bit of trouble and we're going to get out of trouble by investing in the club. And ultimately, it's if you're trying to get healthy in any business, I don't care what you do, what service or product you make, it's about investing your way to health, not cutting your way to health. You're never going to cut your way to a point that says, okay, we've cut our way to health, now we can get in the investment cycle. Right? It's not, no business works that way. It sometimes takes bold moves to this is what I call the on-ramp into the growth cycle. Just very quickly, the notion of how, can a club in fact measure its return on equity? In the investing world, how do other industries measure value creation? There's this notion of return on equity, and equity is essentially the amount of capital that's been invested into the business over time, but if we look at it in a given year, and the return on equity is what's the profit that company generated relative to that amount of invested capital, and it gives you a return on equity. And companies that are in high return sectors, because they're higher risk and therefore higher reward. Technology companies, they demand and they deliver high returns on equity. Clubs that are in a lower risk scenario, commodity clubs, basic materials, iron ore and copper, those don't have the same risk profiles, and therefore those return lower amounts on equity. And we're going to, in a couple slides, a few slides, we're going to actually look at what's our take on the club industry. Can you actually measure return on equity in the club industry, and therefore understand and measure, what's the return on equity for clubs in this cycle versus the clubs in this cycle? And I think you're going to find it, very interesting. It's, I think, a fairly novel notion to present, to the club world. What we really try to do, as many of you know that are subscribers, and if you're not subscribers, you've probably heard us speak a lot. We do have a very business-oriented view of clubs, and that has unveiled many, many valuable things about how to benchmark and measure clubs and how to take that into the boardroom and make decisions with it. This is just an extension of that. And now we're getting into the world, though, of bringing, the art of value along with the finances. But if we look at, one of the measures that we use to say what's the horsepower, the investment horsepower of a club, if you will, it's what we call net available capital. It's basically at the end of the year, after operations and after capital income, what's the pile of cash that the club created that can be used for investment or debt reduction or putting away in reserves? And we just take that pile of cash and divide it by the operating revenue of the club to size it. And we know, the clubs that are in this lower quartile we call capital starved, and the clubs in the upper quartile we call capital rich. And it's fairly intuitive that these clubs would probably be in different relative positions in terms of the investment cycle, but we'll look at it specifically. And the goal, again, of this is to help clubs drive themselves in the right direction. A, recognize where they are, and B, understand the clubs that are, frankly, more successful than we are. What are the attributes that they have, and how do we emulate those attributes? And so when we just, quickly peer in, all we did was blow up that lower quartile and upper quartile. We find that the capital starved clubs, half of them actually stole all their capital to patch up operations and had nothing left. They actually burned cash after that. But basically that, in the middle, that's a 0% cap. They have no capital to invest. And the capital rich clubs, have 20% of their revenue as a number to invest back in the club. So capital clubs, obviously, by definition, have very little to invest back in themselves. And as a result, they do invest much less back into themselves. So capital rich clubs in the median invest about 10%, sizing, about 10% of their revenue back into the club every single year, year over year. Capital starved clubs, basically across the spectrum, invest about half of that. So capital rich clubs, not just as a dollar amount, but as a percent of their revenue, they invest twice as much as capital starved clubs. And this is what I'm calling that start of that investment return cycle. And so, if you buy into the thesis of these growth cycles and decay cycles, the way you get off that cycle, the decay cycle, is to figure out, if we're down in this region, how do we, you have to be smart about it, because you have to be strategic about, where you're going to shoot maybe your one bullet. How do we make a significant investment to try to drive that interest and demand in our club so we get on that cycle, right? That's the hard part. That's the starting line of the whole thing. Interestingly, initiation fee plays a huge part in this. Coming into the decline we had a few years ago, many clubs got into the mode of, frankly, out of fear, but I get how it happens in the real world, of saying, we need to cut our initiation fee. That will spur demand if we cut our initiation fee. So a couple interesting things. I did a ratio of, I took the initiation fee and measured it relative to the annual dues that a full member pays. And so it's amazing. A quarter of the clubs in the country, their initiation fee is less than the cost of 1 year of dues, right? That's a pretty low hurdle, a pretty low, frankly, statement of value that you're presenting to the marketplace. On the flip side, you've got clubs that are, very high, 6, 7, 8, 9, 10 times their dues. And those are clubs that obviously have a completely different positioning in the marketplace as to the value that they bring to the table. And we're not going to go through all these numbers, but if you look at just a couple of the attributes, the turnover rate of members in clubs that live in this quartile is 10%. They have 350 members on average. The turnover rate on the high ratio clubs is 3%. It's 1/3, right? These clubs are turning over their membership every 33 years, and they're turning over their membership every 10 years. And obviously, they have much higher member count. So I'm going to raise my hand and say, in my world, lower turnover and higher member count is a sign of higher demand for the product. In this case, the product is membership in the club. So, as we've gone through, a couple things, what are the things we've learned so far? In tying together, I would say, the intersection of finances and value proposition or value creation. Because you need both, right? You need the culture to be inspired to create value, but you also need the finances to support creating value. So we know that capital-rich clubs invest a higher proportion of their money into the club year over year. That's a momentum thing. They have more members. I haven't shown it yet. We'll see in a minute. They're actually not more expensive to belong, which is very interesting. They have higher initiation fees, higher initiation fee income. Ultimately, then, of course, they have also higher capital dues, which is a great way to generate capital for any club that does not have a capital dues, and more overall capital income, and they have half the turnover. These are some pretty significant building blocks that enable you to stay in that growth cycle. And it's almost like a bit of a checklist, and there's no right or wrong number. It's more of a trend, right? If we were to measure ourselves for these kind of things 3 years ago, where were we then? Where are we now? Where are we going to be in 3 years, right? And you want to see those trends all moving in the right direction. Now let's take just a minute or two, or a couple minutes, and we talked about that notion of other industries use measures like return on equity as a way to say, are we returning value to the invested capital that's been invested in this company, right? If Intel is building a chip plant, does that chip plant start returning profits back to the company, right? That's how they measure return on investment and return on equity at the whole company level. For clubs, it's different. You don't have owner's equity, but you have what, as most of you I'm sure know, have unrestricted net assets. In the nonprofit world, the term is unrestricted net assets. That's equivalent to shareholders or owner's equity, at least in the modeling that we're doing at this stage. So that's a baseline measure to use, as this is the basically sum total of capital that's been invested by the members. They've taken money out of their pockets and given it to the club, just like any business would, to say, invest this money wisely so that you produce value in what we've invested in, right? It's the same thing. And this unrestricted net assets, as we'll see, it can grow over time, it can shrink over time. And we do believe the trend of whether your UNA is growing or UNA is shrinking is actually directly, we don't have the data yet, but we hypothesize that it's directly tied to member satisfaction. So now let's go to that punchline before we go a little bit further. So this notion of return on equity, we explained a little bit about what it is. In the for-profit big industry world, it's the annual profits a company generated divided by the shareholder or owner's equity in that business. And that's the return that you gave to that sum total of invested capital in that business. In the club world, let's take a look. It's the same equation. Except instead of profit, we say that the quote-unquote profit generated by investment in a club or by a club is capital income. If you've invested wisely, you should see higher returns on capital income because you inspire higher initiation fees, or you enable higher initiation fees. You inspire more members joining the club, and you probably ultimately inspire, either creation of a capital dues or some increasing in your capital dues. But ultimately, between all those things, the profit is where we're calling that total capital income as the numerator of the equation. So, I'm sure you've read it before I'm getting there, but lo and behold, what you find is that capital-starved clubs show a return on equity in the 5% range. Now, let's look at our industry comparison just for the heck of it. These are commodity businesses these commodity industries have a 6% return on equity. By definition, capital-starved clubs have a return on equity profile as a commodity business. Now, we all have been in the industry long enough to know that clubs really do not want to be perceived as a commodity club, right? Every club wants to have differentiators about it. Why clubs join my club versus the other club, right? Presumably there are differentiators there. And if all you're doing, these clubs that are in an area where there's maybe too many clubs, or that it's been challenged, and all the clubs lowered their initiation fee to zero, and they haven't increased dues in 5 years, and they are creating commodities of themselves by definition. They're making price the only factor that says, am I going to go to club A or club B? As opposed to, frankly, it's not easy to do, but getting on that investment cycle and actually saying, no, everybody else in the area has a zero initiation fee. Ours is $5,000 because we understand the importance of reinvesting back in the club every year so we can keep bringing value to you as a member year over year over year, right? We're not about being the low cost club, the commodity club. We're a differentiated club. So, very interesting that these capital starved clubs show up as commodity businesses by definition. On the flip side, these capital rich clubs have a return on equity of 13%, right? They're generating, a pretty decent amount of capital income relative to the unrestricted net asset base of the club. And, it kind of puts them, you wouldn't expect them to look like a tech company, but it puts you kind of in the middle of a lot of industries, utilities and consumer goods. Pretty rational thought. When we saw this, we said, hey, this makes a lot of sense, and we think there's some value in clubs starting to think about themselves this way, right? How do I measure if my investment I made was a good one, and what's the benchmarks I might use against that? And so the question is, do you monitor your unrestricted net assets? And our view is it should be increasing. One of the reports that users can run in club benchmarking is called the multi-year trend report. And one of the charts in that is unrestricted net assets. So I took out the comparative data because it wasn't important. This is just this one club. Here's the UNA for this club over a 5-6 year period, and you can see this was a capital rich club, and in fact, the unrestricted net asset base of this club did increase. This is a club that was investing in itself over time and clearly was generating enough capital income to keep reinvesting in itself, so it had a growing asset base. That's, if you're a member at the club, that's the shape of the curve you want to see. Now, let's look at the flip side of that. Here's a capital starved club, right? Here's the 5% return on equity club. And so it's obviously a very different trajectory. This is a club that's actually, when you think about it, it's consuming itself. Its asset base is depreciating at a rate faster than it's actually replacing those assets. Forget about big, bold, new ideas, new investments, right? This club isn't even maintaining its asset base. It's actually shrinking its asset base because it can't keep up with asset depreciation, end of life. It's made a little bit of a move here. There's clearly been some recognition, and I know the club. I'm not going to say who it is, of course, but there were some specific decisions made around this kind of data to help try to change the trajectory because it's not a good one. And I'm guessing that there are virtually no boardrooms in the country that have ever looked at a chart over time of what's our unrestricted net assets. Is it growing? Is it shrinking? And what does that tell us about our investment profile and our return profile for the club? Very, very important in our view. Just that we're not going to look at this whole chart, but just as an example for how the marketplace and how investment ultimately ties together in terms of value. Let's just, for the sake of simplicity, these are pie charts of operating expense allocations in the club, and we're not going to look at each slice. Just know that the yellow slice is non-golf sports. It's the family-oriented stuff, right? Tennis, fitness, aquatics, and the green slice is course maintenance. And clearly, these slides show clubs of varying degrees of how much are we just a golf club? I should say only a golf club, because a lot of great, beautiful golf-only clubs. And how much are we a big, wide, diverse country club, where we almost are 50-50 between those two, big amenity sets. And if we just look down at the lower level here, initiation fee and dues, initiation fee 14,000, 24,000, 24,000, 57,000. So the marketplace has spoken and has told us that clubs that have big diverse sets of amenities are able to capture higher initiation fees And if you look at the member counts, it's not surprising. I mean, these tend to be bigger clubs, so more members isn't surprising. But you can have more members without necessarily commanding a higher initiation fee. Here, these clubs clearly are commanding a higher initiation fee as they've gotten more and more diversified. It doesn't mean that's the right answer for every club, but it is worthy of note. By the way, also worthy of note, people think that being at big expensive clubs are more expensive to be members. And if you note, the average dues rates are almost identical across this set of clubs. So it costs more to join that club, but it doesn't cost more to be a member at that club. Um, so that was just one example of how certain clubs invest, right? They're saying we're going to move up the scale. A lot of clubs now are doing bigger fitness, bigger tennis, new pools, those kind of things. But, there's a lot of different type of investment. You've got Union League of Philly, which frankly is a poster child of how to grow through, I mean, they are, if anybody that knows, Jeff and that club, they are firmly entrenched in that green growth cycle. They're doing big, bold things, starting from buying parking lots way back to now buying this bungalow restaurant on the Jersey Shore. Why? Because a lot of their members leave the Philly area for the summer and go to the Jersey Shore for the whole summer. And they're fighting restaurants. It's hard to get seats in restaurants. And they said, why don't we buy a restaurant on the Jersey Shore, make it members only? It's now part of the club. Members go there. That's a big, bold idea. Anyone else that knows them knows they recently added a golf club to their mix. So they're off the charts on innovation, but it's an interesting example to aspire to. In fact, I'm going to give you how that impacts culture. I saw Jeff a few weeks ago at an event, and we were talking about this, and he said he's got members that now walk up to him and say, "Hey, when is our next assessment going to be? Because we're really excited about what you've got. What's coming next." That's amazing, right? They're literally asking for the next assessment, and that's ingrained in the culture. That's serious, and a number of other things. They're not all the same, right? This is a big fitness center and actually bowling area. This is investment in the culinary talents of the F&B staff. The point is, all of these investments are tied to member value, right? Every one of these things has a tie that a member says this is something valuable, and to prospective members who would look at it say this is something valuable. Just as an example, on the flip side, we recently worked with a club who about 6 years ago, it's a nice club, beautiful club. They were in a little bit of a struggling area, and they had a shot at doing a major investment. And they basically had two areas of the club, both of which needed redoing. The member area, which was the grill room and the bar and the place that the members go and use, and the banquet facility. And at the time, they were sort of led down a path of, spend, and it was a fair amount of money, $5-6 million. Spend that money on the banquet facility because that'll drive all these banquet revenues, which will drive the finances of the club. Well, of course, lo and behold, 6 years later, we all know how that food and beverage thing tends to turn out. It didn't drive profits into the club. It, was a nicer banquet facility. There's no doubt about that. But it didn't really talk to member value. It didn't. You still walked in to the member grill area, the main member area, and the perspective was this is kind of tired. And it was beautiful. It was out on an open water area. Now, if that $5 million had been put into the member side, so that members were, thrilled about it, and that prospective members could get thrilled about it, I think that's a different return on investment, return on equity, generating capital income as a result of the investment, right? Get you into that cycle. They got on the road, the on-ramp to the investment, but in their case, they maybe that same decision may work in some clubs, but it didn't give them it didn't increase member demand or member satisfaction. And investment, that's the key thing here, is if you're going to invest in things that are directly tied, first and foremost, directly tied to member demand and member satisfaction, so that you're not a commodity-like club, but you're a differentiated club. So, now I've just went through it. More capital investment drives broader amenities and nicer facilities, which drives demand, which drives initiation fees, which drives capital income, which lets you continue that cycle. It's again a 2 to 3 year kind of cycle, but it is a cycle. And if you don't get in the cycle, you can't be in the cycle. That's kind of the notion that we're trying to bring to the table here. So, you know, if you're in a decay cycle, and most clubs know, some don't, by the way, some, when they join and they look at their ratios, their capital ratios and their net assets, we find out with them, where are you in that cycle? You don't not want to know, you want to know. But if you're in that decay cycle, it does require some bold strategic thinking to say, this is where we are. If we don't do something significant, this is not a good path that we're on. And ultimately we all know it. We see in the industry, folks that are private equity companies and such that are buying up clubs, they're kind of bottom feeding on clubs that are in the decay cycle but are in nice areas, and they're going to come in and they're going to put the club on that investment wheel, right? That's what they're doing when Club Corp or Concert Golf or any of these other folks come in. They buy the club, and the first thing they do is they get on this on-ramp for increased capital. Why? Because they get the correlation to demand ultimately from current and future members. So it's a momentum thing. Every club, of course, needs to decide. I can't tell you what you should invest in. Every club needs to decide, where are we lacking and what's the thing that we could do that have the best impact, the most impact on member value. And then we can, in fact, measure the effectiveness of that investment. So, there are cultural and financial aspects to decide: are we here and are we staying here? Are we here and are we staying here? Are we moving? Hopefully not moving from this side to this side. But if we're here, what are the things that we could do? Let's recognize it. Let's face up to it. And what are the things we could do to move over towards the value creation side? It doesn't take a lot. If you've been a cost-cutting culture club, well, that's hard to say, for 3 or 4 years, it doesn't take a lot to start to, swing that tide a little bit and to just produce something that people say, wow, this is great. Maybe it took an assessment, maybe it didn't, I don't know. But, it's looking for some of those small wins maybe at first. So there you go. So, my parting thoughts, and then we'll ask some questions. And as usual, I've turned my 30-minute Fast Fact webinar into about a 40-minute, but I think most of you have been on them before, so that's a pattern. But my parting thoughts are, every club has the opportunity to be a value creation club, every single one, and that decision point, lives at the intersection of culture and finances. Now, how deep you are in the cost-cutting culture versus, towards the value creation culture, requires different levels of, intestinal fortitude to get you moving in the right direction. But those opportunities are there, and sometimes it needs, the deeper you are, by the way, into the wrong side of that, into the decay cycle, the more you obviously need your membership strongly behind whatever it is you're doing to move you in the right direction, right? I mean, if you're, to flip on the other side, right? How much cajoling does where the members are asking for the next assessment because they know the money's going to be so well spent? There's not much cajoling that needs there. So those are sort of bookended as well. Obviously, rising initiation fees and capital income is a great gauge of if, in fact, we're increasing the value proposition. It should be, people get complacent in their initiation fees, and I think it should be a fairly frequent question of, can this project allow us to increase our initiation fees, or just the question of what could we do that would increase the initiation fees? Because what you're really saying is what would be a differentiating value for this club. Growing or shrinking, understand that unrestricted net assets, and certainly if you're a club benchmarking member, just go in and run that. There's a balance sheet and capital report, and I'm sorry, no, it's in the member. It's in that, but that's just for a year. It's in the multi-year trends report, and you'll see yours over the years, at least for as many years as you have data in. But it is about getting on that on-ramp to the growth cycle. And I truly believe, if you remember that the pie charts there, or the circle charts of growth and decay, every board member, as we talk about these things, it takes years. Every board member coming onto a club should have those two circles, ingrained in their, burnt into their brain, right? Where are we going to be? Are we going to be this kind of club or this kind of club? Very, very important for them to start to, recognize this and have those strategic discussions, as opposed to, the deal, right? Where are we getting our next banquet from? And how come our cost of food went up 2 points? Those are not anywhere in the realm of discussion of value creation type of clubs. So I think that is my last slide. So I do want to stop now, and I think we'll open it up to see if Terry has any questions that came in. I'm happy to answer, stay on as long as we need to answer those questions. Terry, did you have anything come in?
Actually, I don't see any questions. You must have been pretty clear.
You know what? I saw a couple, so maybe you weren't getting them.
Okay.
I have a few. Here's a question about some ROE. Do you have a benchmark on percent of revenue spent on capital improvements annually? Yes, that was one of the charts, and I know I went through those fairly quick. I'm going to pop right back up there. Here it is. So this is capital investment as a percentage of operating revenue. Now, obviously, the capital isn't coming from operating revenue, but that's how we're sizing it. So capital-rich clubs spend basically twice the percent as capital-starved clubs. At the median, it's 6 and 10, 3 and 6. So yeah, those are the benchmarks for that. And there are some clubs that spend even significantly more than that. So that was that. Can you expand on the ratio of initiation fee to annual dues? I can and I will. I don't know I don't know specifically what you want to know. So feel free, Charles, to give me a call after the fact or email me, and I'm happy to discuss that with you. And how do you address those clubs who are corporate owned? Interesting. How do you address those clubs that are corporate owned and everything is a profit center? Is this just focused on member owned clubs? No, not really. I mean, I think you'd want to, corporate owned, sometimes they have initiation fees, sometimes they don't. What you do is if everything is a profit center, then you wouldn't use that capital income or net available capital number as your denominator or as your numerator. You would use the profit, right? So if it's a for-profit club and they don't necessarily separate the capital and operating ledgers like non-for-profit clubs do, you would just take whatever that net annual number is and divide it by those that asset base. In that case, it may be called owner's equity as opposed to unrestricted net assets. But you would do the same thing. So in that case, it would be profit over owner's equity or the unrestricted net assets, however that might be called in that club. Okay, there's a couple other questions I can answer after the fact. I see who they're from, but with that, I think we'll close it down. And I appreciate everybody joining us today. I hope it was valuable. And again, this webinar will be archived relatively shortly, probably sometime later today, and up for viewing. Thanks again, everyone. We'll talk to you soon.